So, in the last class, we actually covered topics like VAR. We introduced VAR. Volatility was covered in detail, expected shortfall. Okay, so basically, all these areas focus on market risk. Okay, mainly potential losses that can arise because of changes in market variables. They can be interest rates, equity prices, foreign exchange prices, commodity prices. And this chapter, you can see the name of the chapter external and internal credit ratings. So we shift our attention to a different dimension of risk, which is credit risk. Okay. And at the heart of credit risk, you have a very simple question that you need to answer. How likely any counterparty or any entity with which you are dealing with is going to default on its obligations? Okay, is how likely it is to default on its obligations. So to help answer this question, you have credit rating agencies which assign ratings to bonds as well as issuers. Okay, so bonds are the instruments which are issued by the issuers. Issuers are the entities which issue those bonds. Okay, and these ratings, they can kind of, you can say, act as, you can say, either proxy or you can say shorthand for credit worthiness, measuring how credit worthy they are. Okay, and different factors are considered by these rating agencies. You can have whether the issue is secured by collateral, how senior is the issue or the debt, what is the maturity of the debt or the instrument. Okay. So in practice, even in the GARP text, it is mentioned that in practice, many rating agencies often assign the same rating to all instruments issued by a given entity. Okay. That is why we treat bond ratings as attributes of the issuer itself rather than just the specific bond. Okay. Also, uh, there are different scales for different types of instruments. We have long-term ratings. In long-term ratings, basically they are used for bonds and other instruments who have maturities greater than 1 year. Okay, and then you have short-term ratings, which are used for mainly for money market instruments. Okay, well, like you can have commercial papers, certificate of deposits, bills, basically with maturity of 1 year or less. So we'll start with these rating scales. Okay, long-term rating scales first, which are used by the credit rating agencies, the main rating agencies. We'll talk about S&P, Fitch, and Moody's. Okay, so as I mentioned that these are quite critical because they are ratings for bonds and other fixed income instruments. Okay, so let's do a side-by-side comparison of how S&P and Fitch classify all the bond ratings versus how Moody's does it. Okay. Now you can see under these ratings also there are actually some of the instruments which are said to have an investment grade rating. So starting from the top, we have these investment grade ratings on both sides. So investment grade bonds are bonds which are considered relatively low risk in terms of default. So for S&P and Fitch, the investment grade starts from triple A, the highest rating with no modifiers. Then you have double A, okay, with some modifiers plus minus. You can see we have under double A we have double A plus, double A minus, and then A again with modifiers, and then triple B. So all these four are investment grade. For Moody's, these are the investment grade ratings. Almost I mean equivalent bonds will be there, but of course the rating style will is different. So you can see the topmost rating is capital A, then two small a's, no modifiers. Then AA with modifiers 1, 2, and 3. So basically, when we talk about AA, we are talking about AA2. Okay, AA1 is a little higher than AA2 and AA3 is a little lower than AA2. Similarly, over here, when we are talking about AA, we are talking about the central one, right? and this double A plus is a little higher than AA, double A minus is a little lower than AA. So these bonds, the investment grade bonds, are considered to have a very strong, or you can say even adequate capacity to meet all their financial commitments. Okay. But below these bonds, you have non-investment grade bonds, or you can say speculative grade bonds, or even sometimes you can say them as junk status bonds. They carry a much higher risk of default. So in the S&P and Fitch system, you can see clearly that we start from double B and finally we go up to say double B, B, triple C with modifiers, of course, all of them, double C, C, and all the way up to default. In Moody's, you have BA, B, CAA, CA, C, and D. So the lower we are moving in this scale, lower down, the greater you have the risk of default. Okay, and these are the ratings which are very, very closely, you can say, watched by risk managers, especially when they are managing different portfolios with credit exposure. I think there are some doubts. Okay. Okay, yes, correct, Nitin. You are asking about modifiers, and Vedant, you replied correctly. They are kind of subcategories under that category. So, modifier, just to make it more granular. Okay, Nitin. So, if you have, say, to see the order starting from the top, first will be triple A, then double A plus, then double A, then double A minus, then A plus, A minus, like this. So, plus is basically a modifier which is being given to convey that this is a little higher than the central one. Okay, so double A plus a little higher than double A, and minus is basically assigned to convey that they are having the rating a little lower than double A, which means the risk is a little higher than double A. Okay, so Vedant is asking a follow-up question. Does high credit risk here mean that the bond issuer would not be able to provide? Exactly. Yes. High credit risk means that the bond issuer has a higher chance of not being or not providing back the promised cash flows. They can be in the form of, see, it also depends on the timing also. I mean, it's not necessary that we are only talking about the amount. When we talk about credit risk, the issuer, if they are not able to provide back the agreed cash flows in amount or in the stipulated time. Okay, so even if coupon payments of any bonds are delayed, even then it is considered some kind of a default. Got it? Because they did not pay on time. Even if they paid the full amount after some time, still it will be a default. So basically, promised payments are in the context of both the amount as well as the time. Okay, fine. So what did we understand? We talked about modifiers. So modifiers like plus, minus, these one, two numeric levels in Moody's. So they are allowing for more granularity, or you can say finer differentiation within a rating category. Okay, you can see D is the default in both the systems. Nitin is asking, can we say CIBIL score is credit risk rating for an individual? You can say it is analogous to the credit worthiness of an individual. Yes. Okay. So it is quite similar. Okay. The only thing is that it is mainly for individuals, right? So yeah, it is quite similar. Okay. Vedant is saying, thank you, sir. One more question, please. Grades to issuers, institutions is readily represents the likeliness of them to meet the terms of the agreement. But what the rating of a financial instrument means, see over here, one thing we very clearly mentioned, that even though the ratings are given to the bonds, okay, the financial instrument, but they are kind of considered as a proxy for the rating of the issuer itself. Okay, so in this case, both are conveying the same information. Okay, more or less. Because if suppose you have a publicly traded company, and in that company, the company has issued, say, 10-year bonds, corporate bonds, and that corporate bonds has gotten a rating of say triple B. Okay, so we will assume that the firm itself, the institution itself has a rating of triple B, and the implication, the meaning is same, because see, even at the instrument level, Vedant, let's say if a bond has been given a rating of triple B, and you just have to isolate the meaning in the context of that bond only, then the meaning is still the same, that the bond, okay, the bond is more likely or less likely to pay its promised cash flow payments depending upon its rating. Got it? That is the whole idea. So the meaning and implication don't change whether you look it from the perspective of issuer or whether you look it from the perspective of the issue. Okay, fine. Okay, now since we have seen the long-term rating scales for bonds, we also have to see this side of the picture, the short-term ratings. So long-term ratings were focusing on the likelihood of default over many, many years. Short-term ratings apply to money market instruments, okay, with maturities of less than 1 year. Okay, and this day it is very important that money market instruments, we cannot take them lightly. In fact, they are very important for liquidity management, and their ratings will reflect the issuer's capacity to meet their obligations in the very near term, you can say. Okay, so you have short-term rating systems used by S&P. Let's start with S&P. So the highest ratings are A1 plus and A1. So of course A1 plus is the highest, then you have A1 under that. So basically, again, more granularity, which indicates a very, very strong capacity to meet short-term obligations. Then you have A2, A3, B, C. B, C, you can say they are merely speculative. And then you have D as default. Then you move to Fitch. Again, the idea is completely same. You only see the difference is that A has been replaced with F. That's it. Okay, and there is not a hyphen over here. So there was a hyphen in S&P. In this case, there is no hyphen. Okay. In fact, one hyphen is missing here also. There should be a hyphen, I think, over here. Anyways, just writing convention. Okay, so it's completely same. Then you have Moody's. Okay. So for Moody's, their short-term ratings are actually referred to as these P stands for prime ratings. Okay, so P1 indicates a very high ability to repay short-term obligations, and of course, as you go down to P3, it shows acceptable kind of ability, but with, you can say, a lot of vulnerability. Okay, I think there is another doubt which has been asked. Uh, Bond with higher rating offer lower coupon. Not necessary, Krishnendu, not necessary at all. Okay, coupon rate has a role to play, definitely a role to play in assignment of the ratings. Okay, because when the ratings will be assigned, then it will be seen that what are the coupon rates relative to the market interest rate. That is very, very important. Okay, and in general, we can think that okay, the higher rated bonds should, it makes intuitive sense to say that they should carry lower coupon, okay, because they are promising less. But and that's why they are giving lesser yield, because they have low credit risk, so they have to give lesser yield. But it is not necessary. See, again, it also depends on the initial market price of the bond. What if the initial market price of the bond itself was high? Then by implication, I mean, it automatically implies that the coupon will be on the higher side. So there can be some bonds which are paying higher coupon, but still they are enjoying higher credit ratings. Okay. Next question, Vedant is asking, how do credit rating agencies assign ratings to new issuers who have recently entered the money market with no prior history? Now, there are certain very strong rules. In fact, these top credit rating agencies, they don't even get into the picture unless and until you have a decent amount of, I think there are some rules with respect to the amount of credit history that you need, okay, to be rated by some of these agencies. Okay, so I think uh, if you have a very new company, okay, entered into the picture, and has zero history, then I think it's going to be very, very difficult for them to obtain the ratings by these primary rating agencies. Of course, there will be other agencies or other systems by which things can be measured. Okay, but even then, I think there are some laws, there are some regulations based on which these first year instruments can be rated. Okay, I think there should be definitely some laws, some regulations governing the rating aspects of these companies or issues which have come very, very recently into the picture without any prior history. Okay. How frequently the rating gets revised for financial instruments? We will see that question in particular, Nitin. Don't worry. After a few slides, we'll see through the point. We'll see in through the cycle. Sorry, and in at the point. So we'll see the differences, and you'll get an idea of how frequently they are revised. Okay. Okay. So yeah, so basically short term, okay, NP is not prime, okay. It means that the instrument is speculative and does not fall into the prime category. So what are the key takeaways? Key takeaways from short term ratings are that they help the investors, they help the risk managers to assess default risk, okay, over a shorter time horizon, you can say. Near term obligations are important in this case, okay. And this is especially important for liquidity sensitive instruments. Okay. For example, you can have commercial paper in that. Okay. Next. Now, short term, long term, we have discussed. So, one important question is that how reliable are these ratings in predicting defaults? Okay. So, to answer these questions, this kind of questions, the rating agencies publish historical performance statistics. They measure how often issuers with certain ratings actually default over time. Okay, so there are three key measures of historical rating performance. You have CADR, cumulative average default rate. So this measures the probability of an issuer with a certain rating defaulting within a specified time horizon. Okay, so it can be a 5 year time horizon or 10-year time horizon. Okay, so for example, if you see the table that we'll show after this slide, triple A rated issuers, they have extremely low CADRs. Okay, while of course, as you move to the lower rated categories like B or say triple C, they will show much higher CADRs. Okay, so this will help the investors understand the long-term reliability of ratings. Of course, uh, if suppose the CADRs are actually following this pattern, then it means that the ratings can be deemed to be reliable. But of course, things change with time, and we can only judge based on the historical performance, right? Then you have another parameter which is unconditional default probability. Unconditional default probability is the probability of an issuer defaulting in a future year. There is no conditioning done over here. Okay, so it is the probability of an issuer. Let's say if you want to discuss the probability of any triple B rated bond, okay, in the third year, okay, then we don't assign any given that condition. Okay, given that something has already happened, so you are measuring it from the point of view of time today only. So from the point of view of today, what is the chance that a particular issue will default in year 3 or year 4? That is the idea. Okay, so it is completely unconditional and measured from the point of view of today. Okay, automatically, see, one thing is very clear, that if I have to discuss the probability of default of any triple B rated bond, say in the third year, then it automatically implies that it will default in the third year if it survives the first 2 years. Okay, so we don't need to confuse it with conditional probability. That, I'll first discuss conditional probability. The conditional default probability, again, It is the probability of default given that the issuer has survived for a certain period. Given that the issuer has survived for a certain period. So basically, it is discussing the probability of default in the next year itself, given that it has survived a few years. So the same question, if we flip to conditional, the same question when we were asking about triple B bond, the probability of default in the third year, given that it has survived the first 2 years. So it means now we are talking from the point of view of t is equal to 2 years. Not the 2 years have already passed by. It has survived. It is given that the bond has survived. What is the probability of default in the next year? So both the things are different. Okay. So if suppose I write, I just want to make this point clear because there will be a formula later on for conditional, which I want to make it very, very consistent with what we studied in conditional probability in QTA 1. Okay. So let's say if you have an event, say A, where we are talking about the probability of default in year 3. Okay. Then you have event B. Okay, let's say this is unconditional probability of default in year 3. Then you have event B, probability of survival up to year 2. Okay, so if these two events are there, obviously the conditional one means probability of default A given B. Probability that the bond will default in year 3 given that it has survived up to year 2. But when we talk about A, okay, we have year 1, we have year 2, and we have year 3. So when we talk about year A, from the point of view of today, at this point, so unconditional probability, again, I'm saying we are measuring from this point in time. Over here, we are measuring the unconditional probability. And automatically, if you are measuring it from here, it implies that the unconditional probability of defaulting in year 3 automatically includes that the bond has to survive up to year 2 to default in year 3. Okay, so whether you write A or you write A and B, both are actually same because A itself implies that B is already present. But A given B is different because the point of reference in terms of time changes. So point in time, or you can say reference point in time, is t is equal to 2. And in this case, reference point is t is equal to 0. And they both are same. They both imply. In fact, A implies A and B. So this is a point which I'll actually make use of when I'm going to explain the conditional probability formula intuitively in the same context in which we studied conditional probability in QTA 1. Okay. Now I think there is a doubt. Yes. Why the term cumulative in the, because it is actually cumulative. We'll see that because as you move forward, you are actually finding up to that particular year. So it includes the default probability of 1, then 2, then 3, like that. Okay. So it's actually cumulative, and we'll see the example with that. Don't worry. So let's take an example. Okay. So this table exhibits a small data set out of the cumulative average default rates produced by S&P for bonds within the period of 1981 to 2018. Okay. So let's just quickly walk. And of course, this is a small data set. Generally, I mean, in the curriculum also, they have given the entire table. So we have just taken out a small data set okay, for readability purposes and understanding purposes, so that it is more clear to you. So let's just walk through how to interpret these numbers. So these are cumulative average default rates, the CADRs, for different rating categories. You can say we have taken a small data set, which means only a 6-year horizon has been taken. In the main table, you'll see that up to 15 years data is given actually. In fact, more than that sometimes. Now on the left, this column, you see rating categories from triple A to triple C. Okay. And across these columns, we see the time horizon in years. Okay. So basically, if you have to say, talk about say triple A. So triple A rated bond has a 0.35% cumulative probability of default within 5 years. Within 5 years. Okay, cumulative probability. Cumulative means, again, I'm saying cumulative means less than or equal to. So basically, it can default. If you want to find out the probability of defaulting any time on or before 5, this is the probability 0.35. I hope it is clear now, Vedant, why they are called as cumulative probabilities. Okay.
Sir, I have one doubt.
Yes, yes, please go ahead.
So here I see, right, AAA 5-year default rating is 0.35, but
Mhm.
on a similar lines, AA is 3.32.
Mhm.
Ideally, it should be more for AAA because AAA is higher rated
Yes,
than.
yes, yes. Ideally, it should be more for double A. Actually, it is a problem. I think the first thing that I actually saw where I thought that most probably it is a kind of typo. That is what I am able to figure out right now. I think it's a typo, and I'll just get it checked if the numbers are correct or not. Because otherwise, for all the other uh,
Yeah, it's
rules,
increasing, right?
they
I mean,
seem
it's the default
consistent. They
percent.
seem
Yeah.
consistent. Absolutely. So this is a typo. Okay. Get checked, and this is the same data which is given in the curriculum also. And I remember now, I mean, I think last year or a couple of years back, the same table which we had from 1981 to 2016 earlier, when it was modified, updated, we actually did not use the updated table and we were relying on the old table only, because I think we found this kind of inconsistency only. That why it is with double A. Maybe this has been historically observed. That is also possible. I'm not disputing that, but the chance is very, very, very rare. Maybe just between, because see, if you see the second year, it is completely fine. I mean, first year it's completely fine. 0.02, 0.06 is completely fine. The problem starts from the third year, right? Third, fourth, fifth, sixth, all these numbers are less than triple A, which doesn't make sense intuitively. But I think because of this discrepancy also only, I think we refrained from using this table earlier. But anyways, this is the same data which is given in the curriculum. Okay, we just have to cross check once again with the actual data set if this was true or not. And also, one more thing is important. See, till sixth year, the data is given very clearly. Now, if you go to subsequent years, okay, after year 6, so in year 7, year 8, year 9, and then gradually for double A, the CADR actually increases. So it is possible that it has happened. This is only for the time period between year 3 and 6. So this may be possible. Okay.
But this is for which rating agencies? S&P, okay.
This is S&P, correct. Okay, so
Okay.
just get it cross-checked, and if you find any kind of discrepancy, or if you find the data is, we have to change it, because it's the same data available in the GARP curriculum only. Okay, so we'll just use this anyways. As of now, we also need to understand, this point was actually important that you have pointed out. Also, the mathematics part that we need to understand, that won't be a problem. Okay, and in any case, we'll try to use another bond. We'll not use the AAA and AA rated bonds for our illustration purposes. Okay. So Vedant is saying, could this be due to difference in terms of the bond? So see, terms is actually the comparability wise. If you are comparing, say, triple A third 3-year bond and double A 3-year bond, the terms have to be same, otherwise comparability will be an issue. So I don't think it's because of differences in terms only. Then mix changes after year 3 have written due to difference in terms of bonds. No, I think there can be multitude of reasons. It may be possible. Again, I'm saying it might have happened like this because if you go to year 7, year 8, year 9, up to all the way up to year 15, the data is completely fine. The double A rated bonds have a higher CADR than triple A rated bonds. Okay. And even for the first 2 years, it's the same thing. Okay. So we just get it checked. Now let's come to the mathematics part. Okay. So, yeah, as I told you that if you just have to find out the CADR, you just have to look at the corresponding row and the corresponding column. Okay, so again, and all these are in percentage, not in decimals, remember. Okay, so this 0.22 don't interpret by mistake as 22%. Okay, so this is 0.22% only. This is 1.22% only. Okay. So obviously, if you see the numbers, the percentages, you can clearly say the lower the rating, the higher is the chance of default overall, more or less. There can be exceptions. Okay, this may be an exception for some years, but overall, you can say that higher the rating, lesser the probability of default. Now, since these numbers are cumulative in nature, so if you have to find out the probability of default in a particular year, the unconditional probability of default in a particular year, we use the difference between the two cumulative values. Okay. So for example, if you have to take the example of a double B rated bond, okay, and if I have to find out the unconditional probability of default in year 4, can you tell me what is the unconditional probability of default for a double B rated bond in year 4?
5.25%.
That is CADR,
Okay.
that is cumulative.
CD. Okay.
Yes, unconditional. Okay, so you've got one answer. Correct. So 5.25 minus 3.63%, which is how much? 1.62%. Okay, so 1.62% is the unconditional default probability for a B rated bond to default in year 4. Okay, where the reference point of time is today. We are measuring it from today's perspective. Okay, sorry. So this is exhibiting a small data set out of the unconditional probabilities of default. Okay, so all of them having this 1.62 which was calculated. So just like that, all the entries have been calculated first and then they have been entered. All these unconditional default probabilities have been calculated first and then they have been entered. Okay, so for the same data set up to 6th year only. That's it. Okay. Then let's talk about conditional probability, because in unconditional we were talking about the probability of any issuer defaulting in any given year regardless of the past survival. But in reality, see, risk managers, they update the probabilities dynamically. If a firm has already survived the first few years without default, then its risk of default in, say, later years or the next year, it may look slightly different. And that's where we have conditional default probabilities. So the conditional default probability in any given year n is equal to unconditional probability of default in year n divided by PS up to year n minus 1. What is PS? PS is the probability of survival. How it can be calculated? Of course, if you want to calculate the probability of survival up to a particular year, you will simply subtract the cumulative PD from 1. Okay, as simple as that. So probability of survival up to year n minus 1 is equal to 1 minus cumulative probability of default. in year n minus 1. So in the previous example, let's say if we want to find out conditional probability of default in year 4, or basically we want to find out probability of default in year 4, given that the company or issue has survived till 3 years, the double B rated issue that we were talking about is calculated as unconditional PD in year 4 divided by PS up to year 3. So can you just look up to the data? So you'll need two tables actually. You'll need the unconditional PD also. In fact, you don't need that table because unconditional PD and everything you can infer from the first table only. But since we have already calculated unconditional PD, the numerator is how much? The numerator is how much? What did we calculate? 1.62%. Okay. So 1.62% we have already calculated the unconditional PD. What about the probability of survival up to year 3 for this double B rated bond? Can you tell me how will you find out the probability of survival? What will you subtract from 1? The probability of default up to year 3 is 3.63%. So what will be the probability of survival up to year 3? What will be the probability of survival up to year 3?
Sir, sum of
Correct.
0.65 plus 2.1
No,
minus
no,
3.6.
no, 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 no. Just now I said
Okay.
subtract it from 1.
Okay.
This 3.63, okay, will be subtracted in terms of decimal. It will be subtracted from 1. In terms of percentage, it will be subtracted from 100%. So this is the idea. Numerator, you are having unconditional PD. Denominator, you are having 100% minus 3.63%. Okay. So which is 1.62% divided by 96.37%. How much you are getting? How much you are getting finally? What is the final answer? Correct. 0.0168 or 1.68%. Correct? No, actually, don't say 0.0168%, Krishnendu, because see, percent, both of them are expressed in percent. Na? So the final result that you are getting 0.0168 is actually in decimals. Okay. So what we can do, see, to make everything consistent and to avoid any kind of confusion in the exam, it is a good practice by candidates to convert everything into decimal right from the start. Okay, so final answer that you will get, it will be in decimal only, and then you will know that what is the exact value in percentage. Okay, so just to, if you are still getting these kind of errors sometimes, see, and these are silly mistakes that can be committed by anyone. Okay, so that is why you can start by converting everything to decimal from the beginning only. Okay. Now, again, let's just pause here a little bit. And again, let's connect this back to what I was saying earlier about conditional probability, which we studied in QTA1. Okay. Again, I'm writing. What was the formula for conditional probability? What was the formula? The formula was P A given B is equal to P A and B divided by PB. Correct. Right? So in this case, event A is default in year N. Okay, event B is survival up to year N minus 1. Okay, now again, you have to notice this, that you cannot default in year N unless you have survived year N minus 1. Okay, so default in year N automatically includes survival up to that point. And that is why the numerator P, A, and B. You don't see any and. Okay, that is why, I mean, when I was reading it for the first time, the first question that came to my mind was this only, that, why is it not in line with the conditional probability formula? Because if you look at the numerator carefully, it is simply P, A, and B is nothing but P, A only. Because it implies survival up to year n minus 1. So that's why the formula of conditional default probability looks so simple. Unconditional divided by survival. Unconditional default divided by survival up to previous year. Okay. So basically, we are fully consistent with the general definition of conditional probability that we already know. Okay. We have not invented any new formula for conditional probability here. Same rule we are applying in the context of, you can say, credit risk and defaults. Okay. Now, for investment grade bonds, when you talk about investment performance, and for non-investment grade bonds, when you talk about investment performance, you can notice one thing. Let me just write all the and pull the uh, conditional probabilities of default once again. Okay. So for investment grade bonds and then non-investment grade bonds, you'll see that the story is quite different. The conditional probability is actually low to begin with for investment grade bonds. Okay, low to begin with, and it is an increasing function of time for the first 4 years. It's quite clear, right? Then you can say it stabilizes around that level. So it reflects the idea that while the defaults are quite rare for highly rated firms, over a longer horizon, the risk still accumulates. And of course, there will be other uh, numbers also after 6 and 7, and they will be mostly again rising, you can say, a little bit. Okay. But for non-investment grade bonds, okay, if you see BBB and particularly triple C, even for BB it holds actually, even for B it holds. For B, if you see, it starts with 3.44%, then rises, then starts to actually decline. And for triple C, this pattern is even more exaggerated. It's quite clear, 26.89% in year one. Okay. And then very sharp decline. And in fact, by year six, it only becomes 1.72%. What can be the reason behind this? The reason is that for speculative grade issuers, many of the weakest firm will fail early. Okay, you can compare this to a startup. Many of the startups, correct, Ujjwal, absolutely. Okay, so if you have a startup, the highest probability of startups failing is in the first few years only. But once the startup has survived these difficult years, okay, then it is likely not amongst the weakest companies. So that is why its conditional default probability goes down over time. Okay, a very important idea, very important observation that we have seen. Okay, now, okay, till now we have discussed probabilities, whether they are cumulative, unconditional, or conditional, but still they are probabilities. Now let's take it one step further by introducing this concept of hazard, a very related concept, I should say, and very powerful concept, okay, of hazard rate. So hazard rate is the rate at which defaults are happening at a particular point in time t, okay, and it is commonly used by analysts. Okay, you can think of it like an instantaneous default intensity, instantaneous. Okay, it can be a function of time, it can be time varying, it can be constant also, or even stochastic. Okay, now we can link this to survival and default probabilities that we have discussed earlier. So let's say if you have H bar as the average hazard rate between time 0 and time t, the unconditional default probability between time 0 and time t is given by 1 minus e raised to the power negative h bar t. Okay, so all this is basically calculated using, you can say, some calculus tools. Okay, basically integration. Okay, and it has been derived in FRM part 2 also, although it's not a part of the syllabus, but just for information purposes, for those who are curious, we have done it in part 2 main videos. Okay, although it's not required for the exam, even in part 2. So, of course, if the conditional default probability, unconditional default probability between 0 and t, so between 0 and t means what? We are kind of measuring cumulative probability only. If you start from 0 and all the way up to t, if you're going, the default any time between that, so on or before t, basically, we are calculating. So if this is the cumulative probability, can you tell me what will be the probability of survival? We just have to subtract this from 1. Okay. So if you subtract this from 1, you will get e to the power negative h bar t. The probability of survival or survival rate up to time t is given by e raised to the power negative h bar t. Okay. 1 minus e raised to the power negative ht. 1 will get cancelled. Negative negative will become positive. So you can clearly see the math over here. Okay. It's quite obvious. Now, if you want to find out, I think, yes, Vedant, which one? Acha, you answered the question of survival. Correct. E raised to the power negative ht. Perfect. Now, the unconditional probability of default between time t1 and t2. If you have to find out with different hazard rates, this will be the formula. E raised to the power minus h1 bar t1 minus e raised to the power minus h2 bar t2, where h1 bar and h2 bar are the average hazard rates between today and times t1 and t2 respectively. Okay, you can actually uh, just draw a timeline and understand it. See, if suppose this is the timeline, we have 0, t1, t2. What is the probability of default up to t1? This is the probability of default up to t1. What is the probability of default up to t2? This is the probability of default up to t2. Earlier also, when we had to find out the unconditional probability of default in that particular year, so basically we were talking about between year 4 and year 3, right? On year 4 or during year 4 means between the end of year 4 and between the end of year 3. That is what we were calculating. So over here also it's the same. If you want to find out the unconditional probability of default between T1 and T2, we just have to subtract this from this. That's it. And you can see if you do 1 minus e raised to the power minus h2 t2 minus this, then obviously 1 get cancelled out. Minus minus, this becomes positive. This will of course become negative. And that is why you have e raised to the power minus h1 t1 with a positive sign. Okay. And this with a negative sign. So we are just subtracting this, the top one minus the bottom one. That's it. Okay. Now, one thing I just want to point out over here, which I want you guys to be technically very, very sound in this case, in the concept part. See, hazard rate is not a probability in itself. It is a rate. Okay. You remember PDF. PDF was not a probability. Okay. Although I'm not saying it is absolutely analogous to that. No, it is still an instantaneous default intensity. Even PDF was not that. But still, the utility of hazard rate and the utility of PDF and their calculations, okay, and the way to interpret them, the way to interpret the final calculations, you can relate the idea. Correct. So once you integrate it over time, then it gives you the probability of default and survival over that time period. If you have a very high hazard rate, it means that defaults are happening very quickly. So survival probabilities will of course fall very rapidly. And if you have a low hazard rate, it means the issuers are quite safer. So survival probabilities will of course decay very, very slowly over time. Okay. Now, in part 2, in fact, we are using hazard rate a lot. In fact, in part 1, we are not using it much. In part 2, we are going to use hazard rate a lot. We have discussed structured credit risk. We have structural reduced form models. So in credit risk modeling, we'll use hazard rate a lot in FRM part 2. Vedant is asking, is it the instantaneous rate of change of default rates. Actually, it is not the rate of change of default rate. Okay, it is the rate of, you can say, instantaneous default only. Okay, so you can say that uh, if you have an infinitesimally small amount of time, okay, instantaneous, then during that infinitesimally small amount of time, if you have to measure what can be the probability of default, then if you multiply h by that small amount of time dt, you will get the probability. So you can say it is not the rate of change of the default rate, it is the instantaneous rate of default. That is the best way to interpret hazard rate. Okay, and you can get the probability once you start using it. Either you can get the probability at instantaneous at a very infinitesimally small point of time level, or you can get it at larger points in time. Okay, now let's see some examples. Suppose you have hazard rate which is constant at 2% per year. And if I have to find out the probability of default by the end of the third year. So what was the formula? 1 minus e raised to the power negative h bar t, right? So this is the formula. Can you tell me what will be the answer quickly? Okay, you've got 5.85. I think it's correct. Absolutely, yes, 5.8235. Okay, so this is the result. Okay, just uh, check the number of decimal places also. Okay, so some of the decimal places, maybe this can be accurate, or there can be some little bit of typo also here and there, or a little bit of, you know, you can say if you've got 5.85, so over here it is 5.82. Just check Vedant whether this is correct or yours is correct. Oh, this is correct, right? 5.8235. Got it. Now, if I want to find out the unconditional probability of default occurring in the fourth year, see, the question is twisted. It has not asked between year 3 and year 4. It has asked the unconditional probability during the fourth year. So the mistake that candidates can make in the exam, that they will directly calculate the cumulative probability up to year 4. No, it has not been asked. It has been asked between year 3 and year 4, because that is what the fourth year is. So this is what you have to calculate. Okay, correct. Okay, the probability of default in year 4 minus year 3. But if you see in terms of probability of survival, the equation actually changes. This is the probability of survival up to year 3 minus the probability of survival up to year 4. So it makes a lot of sense, because see, in this case, whether you use default probabilities or survival probabilities, the result will be the same, because if you use default probabilities, you are doing this minus this. So obviously the equation gives e raised to the power negative h1 t1 a positive sign and h2 t2 a negative sign. So you can interpret it in two ways. You can interpret either as PD, okay, default, or you can say cumulative PD. So I'll write cumulative PD up to year, or you can say up to time t2 minus cumulative PD up to time T1. That is one idea. The same thing can be interpreted in terms of survival probabilities also, Vedant. Okay, as like this. Probability of survival up to T1 minus probability of survival up to T2. Got it? So this idea can be expressed in two ways. Okay. So we have to calculate this. What is the answer? Please send your answers. 1.86. Okay. So we subtract them and we get around 1.86%. Correct. Okay. Yes. What if I want to find out conditional default probability in the fourth year, given that it has survived till the end of the third year? Okay, so remember, we have to find out conditional probability. It means you will have probability of survival up to year 3 in the denominator, which means you can use this number which you calculated earlier. This number can be used. You can subtract this from 1, okay, and get it in the denominator. And of course, you can use unconditional probability of default in the numerator. So that is what conditional was. Unconditional, okay, in the fourth year divided by conditional, divided by probability of survival up to year 3. So basically, we have to calculate this. How much you are getting? How much you are getting? Okay, 1.98. Got it. Okay. So yeah, correct. 1.98%. Okay. Now, what if I have to find out the hazard rate itself? Let's say the probability of default is given. I have to find out the hazard rate. So this is the question. The probability of default over 5 years for a B rated firm is given 17.33. So it's a cumulative probability taken from the same table. Okay, 0.1733. Find out the hazard rate. Okay, so 1 minus e raised to the power minus h bar times 5. So h bar is the hazard rate, let's say, times 5 is equal to 0.1733. So this is the idea. You have to just find out h bar. I think the bar is a little bit elevated. Anyways, so e raised to the power minus h bar times 5 is equal to this. Okay, we just taken this to the right side, this to the left side, which gives us 0.8267. Now, what is the best way to find out h bar? What should we do on both sides? Correct. Very good. We will take ln on both sides. So once you take ln on both sides, this actually the power of e comes to the left side. Ln of e is 1. So that is why you're only left with h bar times 5, negative of course, is equal to ln of this. Okay. Once you take ln of 0.8267, you will get negative 1, negative 0.19003. Of course, you divide it by negative 5. So you get h bar as 0.038006, or you can say 3.8% per year. Okay. Although this is being calculated as 3.80 on a per annum basis. Okay. But we need to make sure that we understand that h bar is always the instantaneous default rate. This is just the measurement of h bar over 1 year. That's it. Okay. So the question can be asked in both ways. They can ask you to calculate conditional and unconditional from the hazard rate, or they can give you the unconditional or conditional or cumulative, and they can ask you to calculate the hazard rate. Okay. Okay, so till now we were focusing on probability of default. But see, the probability of default alone is not going to tell you the full picture about credit risk. For lenders, for investors, a very important question is that if a firm defaults, how much of our money we are going to lose? Okay, that is why we have concepts like recovery rates that we'll see, and of course, LGD also we'll see in this slide. So they are focusing on two main factors when lenders want to estimate the losses. One, of course, you have probability of default, which is the likelihood that the borrower will fail to meet the obligations. And then you have recovery rate, which is the percentage of the bond's value. Okay, percentage of the face value, you can say, that the investors can recover after default. Okay, so of course, a very natural extension of recovery rate. You cannot even say extension there because they're actually complementing each other. It's loss given default. So loss given default is derived from the recovery rate and it indicates the percentage of the bond's face value not recovered. So basically, what will be the loss given default? So it will be, of course, equal to 1 minus recovery rate. So if you can recover 30% of your amount, you lose 70% of your amount. That's it. Okay, then you have expected loss. Expected loss is equal to PD multiplied by LGD or PD multiplied by 1 minus RR. And this is in percentage terms. Remember, this is in percentage terms. And once you get the exposure amount also, you can convert this in dollar terms. You can convert this in dollar terms. Okay. Now, one very, very important aspect is that EL, because there can be a counterintuition over here that, PD, if it's also expressed in percentage and LGD is also expressed in percentage, then why not, we are taking percent square if we are directly converting, or why not we are dividing it by 10,000 or multiplying it by 10,000, while doing conversion and back conversion. Okay. Yes, Vedant. EAD also comes in the same equation to convert it into dollar terms. Okay. So this is a percent. That's why I said it quite clearly. It is in percentage terms right now. If you have exposure at default also, if you want to convert it into dollar terms, you will multiply the same thing by EAD. Okay. Okay. Now, before we move forward, we need to address a very important point. What is the point? That recovery rates and default probabilities, they are negatively correlated. Okay, you will have situations, especially in recessions, where defaults will rise because many firms are struggling. At the same time, the recoveries will tend to be very, very low because the defaulting firm's assets, they will be worth much less in a weak economy as compared to what they were in a normal economy. Okay, so in expansions, the defaults are very low. And when defaults happen in expansions, since it is an expansion, asset values are priced better. Okay, they are higher. So recoveries are also better. So you can quite clearly see that this is especially the recession part, when you see it is actually a double problem in downturns. And this is something which we'll see in part two, which we call as wrong way risk. It is a double problem because the same time you are having higher default rates, the same time you are having low recovery rates. So the losses are actually compounding. Okay, that is the problem. Now let's take an example. So again, we'll use the same BB rated bond that has an unconditional probability of default of 1.62% over 4 years. The LGD is 40%. Let's say we have estimated the LGD to be 40%. We just have to find out the expected loss. Credit spread we'll see in the next slide, okay, when we introduce credit spread and all. We just find the expected loss. Okay, so PD is equal to, this will be discussed in the next slide. So PD will be 1.62, LGD is zero point 0.4. So if you want to convert EL or calculate EL, it will be 0.648%. Okay. So what I said that, there can be some confusion in your mind. You might be feeling that, okay, both of them are in percentage. we should have this in percentage square, it's not a problem. But then you have to express both of them as percentage. Over here, you can clearly see that if one of them I'm expressing as percentage, the other automatically I'm using decimals so that only one percentage is left in the right hand side. But since we want EL as a percentage, that is why this makes more sense. There is no problem even if you have both of them as percentages. It will be, in that case, it will become 64.8% square. It's still okay. No problem. Because that translates to 0.648% only. Okay. So this is a very basic idea. And of course, if you have exposure amount in dollars also, let's say at the time this loss will happen, or you're expecting it to happen, you expect that your expected exposure, okay, is say $1 million. You just multiply this with $1 million, this 0.648% of $1 million, and you'll get the result, okay, in dollars also. Now let us come to credit spreads and risk premiums, and let's just connect that same concept of expected loss to credit spreads. Okay, so let's say we use the same bond, the 4-year bond. Okay, the same example, a 4-year BB rated bond, which was having this PD over 4 years of 1.62%. From the table we got this, right? We also got the LGD as 40%. Okay. So what is our question of interest over here? The question of interest is what interest rate should be on the same BB rated credit bond that has an unconditional probability of default of 1.62% over 4 years, where the loss given default is 40%. So we calculated EL already. We calculated EL in the previous example, 0.648%. Now, if you spread this evenly across 4 years, okay, it works out to be around 0.162%, or you can say around 16 basis points. Okay, so this is the extra interest earned on the double B rated bond over the risk-free rate, and that is the credit spread. But this 16 which we have calculated is just the actuarial estimate. So just the calculation that we have done till now. In reality, this credit spread is much higher than the 16 basis points, sometimes even 5 or 6 times higher. Okay, because investors don't just need compensation for this average expected loss. They also require a risk premium. Why? Why do they require a risk premium? First reason, of course, is that the defaults are not independent events. Okay, default will tend to cluster in bad economic years when the recoveries are also low. And of course, this will make credit risk highly systematic, highly systemic in nature. And therefore, it cannot be diversified away. So you can say that investors are demanding some kind of a premium for taking that undiversifiable risk. Another factor is actually liquidity. So corporate bonds in particular are relatively illiquid instruments compared to say government securities. Traders know, that they might have to face a lot of difficulties and high bid ask spreads if they want to sell the bonds quickly, particularly in stressed situations. Okay, so to compensate for this liquidity risk, they also require an extra spread above this actuarial compensation or calculated compensation. So even though this actuarial compensation is 16 basis points, the actual observed spread in the market will be much, much higher, which you can say kind of you can say it just does not reflect expected loss only, but it reflects this risk premium, okay, for systematic default clustering and liquidity premium for difficult trading of the bonds. Okay. Okay, till now we have discussed actual ratings assigned to issuers and bonds. Okay, rating agencies also provide additional signals about the direction a rating may move in the future. Okay, this can come in two forms. You have either outlooks. Outlooks are mainly the agency's view, or the rating agency's view on the likely direction of a rating over the medium term, typically 6 months to 2 years. Okay. You can have positive outlook where the rating is more likely to be upgraded. You can have a negative outlook where the rating is more likely to be downgraded. Or you can have a stable outlook where there is no change expected in the near to medium term. You can also have something like a developing outlook where the direction is uncertain. Okay, it may be due to unusual circumstances like maybe some kind of merger, some kind of acquisition is pending, maybe some regulatory changes have happened, maybe the firm is undergoing significant restructuring. You don't know. So outlooks are not uh, guaranteeing that change. They are just guiding the investors on where the risk may be heading in the medium term. Then you also have watch lists. Watch lists are actually stronger signals and they apply in the short term. They indicate that the rating is actively under review by the agency, maybe because of some event that took place recently or is about to take place. You can have a positive watch list, possible rating upgrade in the very short term or short term, negative watch list, possible rating downgrade in the short term. So, outlook is like a medium term directional view. Watch list means that the rating action could happen very, very soon. Okay. Now, this part you can cover from the PDF rating stability. The PDF has actually, it contains a lot of information. It's very, very comprehensive, as you all know. So the main PDF, I'm not talking about the revision PDF because the revision PDF will not contain that much information. So the main PDF only, right? The main study material that we have provided. Okay, now a very important distinction to understand is the type of rating methodology. Type of rating methodology, whether it is through the cycle or whether it is point in time. Okay. So it was asked uh, some time back that how frequently the ratings changes, how what kind of stability we can expect. So we are going to try and answer that question in this slide. So through the cycle ratings, they reflect an issuer's average credit worthiness over the long term. Okay, they are designed to smooth out, you can say, short-term fluctuations in the business cycle. So since they try to smooth out these short-term fluctuations, because of that, they will understate the default probabilities during crisis. Why? Because see, during the crisis, the current reality looks very bad, but the long-term average looks better. And through the cycle are mainly concerned about long-term average. So that is why during the times of crisis, they will understate the risk. They will underestimate the risk or understate use it. I'll not say underestimate because estimation is not being done over short term in any case. Okay, since it's a long-term view, the through the cycle ratings. So they are understating the PD during a crisis. And of course, they are overstating the PD during stable periods and expansions because the conditions are improving. But since the rating is kind of an average over long term, that's why the rating is lagging behind those improving conditions. Okay. Most rating agencies like S&P, Moody's, and Fitch, they issue the ratings on this through the cycle basis only. Okay. So it means that their ratings are, you can say, deliberately sticky to avoid too much volatility. Okay. So got the idea that, how frequently rating agencies change them? Very less frequently overall, the through the cycle ratings. Okay. Now, by contrast, you have point in time ratings. They actually try to capture the best current estimate of future default probability. Okay. They react much more quickly to changing circumstances like sudden deterioration in financial conditions, sharp improvement in credit quality. They will react very quickly. Okay. And they are actually used internally by banks and financial institutions. Okay. Internally by banks and financial institutions, mainly for their risk management and regulatory capital purposes. Okay. So through the cycle, they smooth over ups and downs. Point in time ratings move with cycle. Now, sometimes the rating users actually adjust the ratings produced by rating agencies to convert them from through the cycle to point in time. They translate, they make adjustments. So, I mean, of course, there can be utility, a lot of utility to this because let's say if you're managing a portfolio during a recession, you will want to adjust the through the cycle rating downward, right? Because they are understating the near term default risk. And of course, if you're doing it in an expansion, you will want to move them or adjust them upward to get a current picture, a proper picture of the current situation. And in practice, many institutions, in fact, they actually use both. They use agency ratings as a stable anchor and internal models to generate adjustments, point in time adjustments, basically. Okay. I think there is a question. Is TTC created from PIT estimates only? Like LRA trends consist of granular E. I think it's a very interesting perspective, but I will disagree to this, Vedant, that TTC are not created from PIT estimates. But yes, you can say that they can definitely, I mean, you can actually make them more granular, but again, it will be conversion of TTC to PIT only, and then they will become more granular. And then you can say if you take an average of all those PIT estimates, then you can get an estimate of TTC also. So it makes a lot of intuitive sense, but I don't think the process is actually using those point in time estimates. I don't think it happens like that practically. Got it? Vice versa might be true. Point in time may actually use the TTC ratings. Okay, and the adjustments might be made. But TTC don't use point in time directly. Of course, there can be many indirect implications, and you know, you can try and average all the PITs to get an estimate of TTC. But that is nowadays how the rating agencies estimate TTC. Okay, so this you can cover from the PDF. Okay, so we discussed traditional credit ratings issued by Moody's, S&P, Fitch, etc. You also have alternative approaches to estimating default risk, which are also used in practice. You have two well-known providers that we'll discuss. We have the KMV, okay, which is now a part of Moody's, and Kamakura. They use models to estimate the default probabilities. Quantitative model, of course, they use the default probabilities, estimate the default probabilities, and they sell the output to the clients. Okay. And unlike rating agencies which provide through the cycle ratings with a lot of emphasis on stability, these organizations they actually provide point in time ratings. Okay. So their outputs of course will respond to changing circumstances much more quickly than the rating agency updates. Okay. See why this happens, because once we after this we'll see that equity prices are a very important input to their models. And equity prices, we all know that they adjust continuously as new information arrives. Okay. So since ratings are reviewed periodically, they are of course slower to react, but equity prices, they change much rapidly, much more quickly. And these equity prices are one of the very important inputs in these models of KMV and Kamakura. So in the simplest version of the model, if V is the value of the assets and D is the face value of the debt, of course the firm will default when the value of the assets is below the total debt that the firm owes, obviously. So the value of the equity at any future time is given by max V minus D comma 0. Of course, whatever is left after servicing debt from the value, that will go to equity. But if V itself becomes less than D, then equity holders get nothing. Okay. It's very clear firm defaults if V is less than D at debt maturity. And of course, this is a very simple model where a single debt has been considered an average face value of the debt, or average debt has been, you can say all the debt has been clubbed together and an average value has been taken. So, or you can say cumulative value has been taken and average maturity has been taken. That also can be true. And those details are actually a part of the part 2 curriculum, by the way. We have different models. In fact, when we see the Merton model, in part 1, we have seen the Black-Scholes-Merton model only being applied to finding option prices. In part 2, we'll see the Merton model to find out the value of debt also, and how to model the value of equity, how to model the value of subordinate debt. All these things have been discussed. Now, you see this carefully. Expression. Does this expression ring any bell from the past, from FMP chapters? Does this expression ring any bell from the past from FMP chapters? Very good. Options pay off, right? So can you say that equity is nothing but a call option on the assets of the firm with a strike price of D? This is exactly what happened. S minus K, right? S is V over here. So the underlying asset is the value of the assets of the firm. Okay, and D is the value of the debt. So firm defaults if the option is not exercised. Okay, if there is no equity, firm, it means that V is less than D. So option is not exercised in that case, right? If V is less than D, option is not exercised, which means firm default. Assets are worth less than the debt. Okay. And of course, since it can be modeled as a call option, then the probability of this can be calculated from standard option pricing theory. And that is what we'll see in part 2. Okay. So credit risk can be modeled using option pricing theory. Okay, so what is the advantage of these models? The advantage is that these model will provide very timely market driven measures of credit risk, because equity prices are changing, right? Then we can shift from external credit ratings to internal ratings that banks and financial institutions develop for their own lending purposes. Again, this slide also, it is recommended to go through the PDF only. I'm just giving you an overview because a lot of details regarding, say, the I mean, I'd say Altman Z score, the model created in 1968 by Altman. All those things are discussed in detail. What are the parameters of the model, and what has changed. Just a brief intro only, I'll say, of that part is given. Details have not been given, but still I'll give you a overview, and then you can go through that PDF. That's not too much of a content. As I said, mostly intros have been given only to all the aspects. Okay. Vedant is asking, does assessing PD based on various factors also? Yes, it is within the part 2 curriculum. Definitely yes. Okay. Now let's see the development banks design and build these systems based on multiple factors like financial ratios, cash flow projections, uh, management assessments. What is the management quality? So what happens is that each factor is scored. All these factors, ratios, projections, management, all these are factors. So these factors are actually scored. Okay. And then a weighted average is taken and a final rating is given. Now, why do banks need their internal ratings? First, external ratings are not always available, especially for smaller or private firms. Second, under the regulatory frameworks like Basel, the regulatory capital requirements, they depend on the probability of default directly, okay, which is assigned to borrowers. Third, of course, the accounting standards like IFRS 9, they require banks to use the probability of defaults when they are valuing loans on the balance sheets. So that is why internal ratings are important. Now, internal ratings can be point in time, which are common but pro-cyclical. And see, if they are pro-cyclical means what? They are point in time, but they are pro-cyclical. Because in bad times, they will raise the PD since they are point in time, and they will restrict lending also. And this is a problem if you see, because when the liquidity is already down in the market, PDs will go up, of course, based on the point in time ratings, which will restrict lending. So liquidity, which is already tight in the market, now even less liquidity is coming. So that is why the problem even compounds. Vedant is saying independent assessment from external ratings and has opportunity of validation of external ratings. So what is the question, Vedant? Yes, definitely. This is an opportunity of validation. Okay, need of internal ratings. Very good. Okay, this is one of the need of internal ratings. You are saying that it is an independent assessment. Okay. Yes, I think it's a good idea that it can be an independent assessment and they can also validate their own systems based on external ratings. But the only difference is that, see, since external ratings are mainly going to be through the cycle and they are point in time, so that's why the validation part might not be as pronounced as they wanted it to be. Okay. So, but a fair point, I'll say, definitely fair point, right? Okay. And of course, in good times, as they are pro-cyclical, they will do the opposite, which will actually lower the probability of defaults. It will encourage more lending, and expansions will be fueled even more. Okay. Now, regulators, they prefer through the cycle estimates for capital purposes. Okay. Now, okay, pro-cyclicality we have already discussed, and now, with respect to validation, of course, which you raised actually, see, validation is mainly about testing how reliable their systems are. Okay, so banks have to backtest their systems to make sure that they are reliable. So typically, this use 10 years of historical data, and it is confirmed that higher rated firms default less often than lower rated ones. So, in terms of validation, also Vedant, rather than relying on the validation by external ratings, they're actually doing the validation based on actual results of defaults. Got it? That is what happens. And nowadays, many institutions are moving towards automation, growing use of machine learning for lending decisions. There was an early example, a very basic model which was built by Altman in 1968, Z score based on five ratios. Okay, any Z score above three was not considered. The Z score above three and I think below 1.6 or 1.3, I don't remember. So these were the two thresholds. Okay, so you can just go through the PDF again. And modern models, they actually use many more variables and non-linear methods. Okay, now let's turn our attention to rating transitions, how ratings evolve over time. So ratings, of course, they are not static. Firms can be upgraded, they can be downgraded, or in some cases, they can also default. So this table shows the 1 year global rating transitions. Okay, rating transition matrix for 1 year. So the rows, they represent the starting rating at the beginning of the year. Okay. And the columns actually represent the rating at the end of the year. Okay. So this is the beginning, this is the end. So each cell is giving the percentage of firms that move from the starting rating to the ending rating. So for example, if you start with say triple A, then 86.99% remained triple A after 1 year. 9.12% fell to double A, 0.53% to A, and only 0.00. It will be 0.00000 something. But okay, in theory, but based on observations, it was actually exactly 0% firms which defaulted. If you start with, say, a lower firm, say double B rated firm, 77.5% remained double B. Okay. 6.65% fell to B. Okay. Some even got upgraded. 0.832 triple B, then 0.112 A, like that. So, if you see, one of the important observations is that these ratings are quite sticky because it is clearly observed that the highest probabilities are always on the diagonal, the principal diagonal, right? The highest probabilities are on the principal diagonal because it shows that the most of the firms retain their original rating after 1 year. And you see upgrades and downgrades are asymmetric. Lower rated firm or lower rated issues, they have a higher chance of moving down than up. You can see very clearly. Okay, so if you take B rated firm, so chance of moving down, if you combine both of them is higher as compared to if you add all of them. Okay, so they are asymmetric. And default risk will increase sharply as the ratings decline. You can see default risk is increasing. NR means not rated, by the way. So maybe some issuers, they just exit the rating systems altogether. That is also tracked here because that can also give some kind of signal to investors. Okay. Now, I think question as asked by Vedant that biggest changes is observed for speculative grades and less for good grades. Why is this so? Biggest changes is observed for speculative grade. Okay, so for these ones, biggest changes in terms of not sticking to the same category. Correct, Vedant? That is the question. Biggest changes in terms of not sticking to the same category, right? Yes, because see, if a firm, as we discussed earlier also, let's say if we talk about speculative grade firms, okay, if they survive the first year, second year, third year, okay, then their chances of becoming better increases. But this matrix is only for 1 year. So in the first year, they are the most risky. They are not stable at all. They can go in either direction, but more so they can go in the negative direction in the first year. That's why the probability of staying in the same rating is much lesser because if they survive the first year, then definitely they will get upgraded, Vedant. But if they don't survive the first year, they will get downgraded. So both aspects is possible. They are not stable. They can move in either side. Okay, got it. Nitin is asking how to read this table. Nitin, I told them the starting point only. I told how to read this table. This is the starting initial rating. Okay, Nitin, this is the final rating. Rows initial, this is the final. So if you want to read any particular entry, okay, in fact we did read these numbers, right? So if you want to read, say, a particular cell, say 5.16, okay, you will say that a rated firm has a 5.16% probability of getting downgraded to BBB in 1 year. Got it, Nitin? This is how we read this table. Clear? Okay. So these transition matrices, they are very important in credit risk modeling. In fact, when we study part 2, rating transition matrix has been used in multiple chapters and a lot of simplified assumptions and simplified tools have also been presented. If you want to extend this set to 2 years, 3 years, 4 years, then the matrix is multiplied with itself multiple times. Okay, so if you want to say find out the transition probabilities for a period of 3 years, you multiply this with itself. Okay, or you can say you raise it to the power 3. Even if you want to say change it to say 6 months, you take the square root of the matrix. Okay, and multiplying and square rooting will be done by the process of matrix multiplication. But anyways, that is not a part of the course. I'm just telling you for information. Okay, so these are actually used to forecast different migrations. They actually there's a chapter in part two, credit VAR, in which the rating migration matrices are used a lot, and other chapters also. Okay, since we have done VAR, that's why I was mentioning credit VAR. And of course, it is important to understand that the ratings are finely dynamic, they are not static. Risk managers have to make sure that they account for the fact how the credit quality is evolving over time. And of course, D denote defaults and NR denotes that the issuer was not rated. Okay. Now, the actual multi-year transition matrix are not quite the same. Now, one thing is important. Say, in theory, as I said, there are theoretical tools. You can just multiply the 1 year transition matrix together by itself to get multi-year probabilities. But in reality, multi-year transition matrices, they are not quite the same as those calculated using the independence of yearly default assumptions. Because if you're multiplying it with itself, you're actually using the independence of default assumption year over year. But that is not what happens. If a firm has been downgraded in 1 year, it is more likely to be downgraded the next year. Okay. And if a firm has been upgraded 1 year, it is more likely to be upgraded the next year. Okay. So this is known as the ratings momentum phenomena. Ratings momentum phenomena, the persistence. Okay. So it means that the rating changes tend to come in clusters rather than being independent from year to year. Okay. So this momentum effect makes this multi-year transition probabilities non-linear. Okay. Also, it is important to understand that rating transition matrices can be calculated not only by rating agencies, or can be presented not only by rating agencies. Rating transitions can be calculated by the by using internal ratings also, and these matrices can also be presented for internal ratings as well. Okay, fine. Okay, so thank you for joining this lecture. Okay, so that's it for this particular chapter. Any questions from this chapter only? Any questions from this chapter only? Okay, very
Sir, I
interesting
have one
topic by
question.
Vedant.
Sorry,
Yes, yes, yes. Yeah,
sorry, go ahead, sir.
yeah. So, yeah, then you just go ahead after this. Vedant, are there any ratings with a continuous, by continuous, what do we mean? By continuous, what is the smallest time division that we are looking for? That is also one very important question, Vedant. So continuous means if just like equity prices. Yeah, as in numbers. Okay, with a continuous scale you are saying. Oh, sorry. I thought again you're talking about, making the point in time as continuous as possible. That is what I thought. So you're saying as in numbers, the scale. Okay. Again, we have, right? I mean, we were talking about Sybil only, right? Although they are not purely continuous because even they are integers, continuous, I don't think it is possible because you need to have a full range of real numbers for that. But yeah, they are quite close to, you can say, that kind of scale that you're talking about. But again, for companies, for bonds, we'll have to check. A very interesting question. Let's just try and find it out. Okay. And if you find anything, I'll also see if we can find any kind of continuous scale. See, the major ratings are not, no, they don't have continuous scale. Even in India, CRISIL does not give the ratings to bonds on a continuous scale, if I am right. Correct? Anyone who can guide me on this? CRISIL, they don't give any kind of continuous rating. Even they have these discrete rating sets, right? So I don't think we have. Still, I'll just check. Nitin, you were asking the question. Please go ahead.
Yes, sir. I was just asking. So there are some ratings for the countries.
Mhm,
Okay, so in terms of the economic growth and all.
mhm, mhm,
So, like, I think every now and then we hear, right, they have downgraded or
mhm,
upgraded the rating for India as a country whole. So, how
mhm.
does that comes into picture?
Actually, we
Is it
have
the
the
same?
next chapter today is country risk only. So in country risk, there are a
Okay.
lot of factors to consider. We also need to consider, it's of course we have the main parameters will be economic factors, but the other factors like geopolitical factors, political factors, not only geopolitical will be different. Political factors specific to that country will be different. Political factors will involve how stable the government is, what kind of continuity you have in the policies, okay, whether you have a functioning democracy or not. And of course, in economic factors, a lot of things will come, how developed the markets are, okay, what kind of property rights you are having, okay, what kind of ease of
Mhm.
business you are having. A lot of things are important in that.
Okay.
Got it?
Okay.
So we'll see that in the next chapter.
Okay.
Okay. Yeah. Anything else? That's it. Okay. So that's it for this lecture then. Thank you very much. We'll just end this lecture.